The hearing will be called back to order and reconvened. The chair will recognize himself at this time for 5 minutes. Ms. Fox.
Yes, sir.
In your testimony, you assert that H.R. 1214 could provide congressional approval for payday lending. I find this argument somewhat confusing. By not acting to curtail payday lending over the all right, sorry. Ms. Fox, it's clear that from your testimony that you are very much opposed to H.R. 1214 and any attempts to regulate payday industry that would stop short of banning the product. Part of what you do for a living is to count votes. Is there legislation currently in the Congress that would ban payday lending that you believe has enough support to pass both chambers and be signed into law?
We believe that consumers need protection from all forms of extremely expensive credit. Senator Durbin's S-500 and Representative Spears' H.R. 1608 would provide the traditional 36% small loan rate cap that would cover everything from bank overdraft loans to payday loans. President Obama ran on a platform of supporting a 36% rate cap, and voters in America support
Reclaim
that
my
by
time,
70%.
Ms. Fox. Does that piece of legislation you just cited have enough votes to pass?
I am ever hopeful that Congress wants to support consumers caught up in a disastrous credit market.
Thank you, Ms. Fox. Ms. Fox, you know, you've heard the testimony of Ms. Guzman. She did say, I believe her term was a necessary evil, something that people don't want. But and I'll be the first to agree that I tend to not have a lot of problems with payday lending. Mm-hmm. But if you just simply foreclose the option outright, what happens to people like, say, Ms. Guzman? Does she now have to bounce a check to get that water heater she needed? What about the situation where you need some money, you don't have anybody to go to, and your options are bounce a check or just suffer, I guess? What about that?
We think consumers deserve better than payday lending.
Okay, Ms. Fox.
And in California...
Thank you, Ms. Fox. So, Ms. Guzman, what your situation? I mean, do you think that the bill we're talking about now balances the equities in a reasonable way? As you already pointed out, you're no big fan of payday lending either. But if you gotta do something and you're really in a jam, do you think that it balances the equities?
I think it's offering a very realistic answer to payday lenders. It all gives them the option and access, which is the American way, and at the same time it protects the consumer, which is what we look traditionally from our government for, minimal amount of protection. In this case, from the situation getting out of control or not having, you know, the certain protections you need to continue, not to continually live in this type of debt.
Thank you, Ms. Guzman. Mr. Flores, how could the payday product be improved to make it more useful to the consumer? In other words, eliminate the debt trap and to make the loan easier to repay. Do you have any views on this?
Yes, sir, I do. I've read the legislation, and I agree with certainly the disclosures. I'm not necessarily for the truth in lending disclosure because I think that's misleading. I like the 6-month payment plan that certainly offers relief to the consumer. And so I think those would be the key issues. One point I would like to make, though, on that legislation is the 15 cents per dollar cap. Philosophically, I'm against price caps or price controls, and not just from the business's profitability standpoint, but as businesses grow and costs increase, be it salaries, overhead, whatever, there's no additional relief for that company to do something with pricing, short of trying to control expenses more. And so I think that is an issue that I would take with this. Otherwise, I think the bill will strike the balance that you're looking for.
Mr. Flores, in your testimony, you also indicate that, quote, the legacy cost structures of banks inhibit their ability to offer short-term, low-dollar credits in a profitable manner, unquote. Could you elaborate on what you mean by that?
Banks have a huge investment in what we call brick and mortar, branch offices around the country. They have huge operation centers, information technology centers, personnel, and the way they're designed, the cost for them, and we looked at this many years ago, and a lot of banks, we said, you cannot make an individual loan under $5,000. The resource it needs, the individual resource, the systems resources, the compliance cost, the documentation cost, to make a $5,000 loan is the same that would make a $500 loan. And they just don't have the cost structure to efficiently offer that product.
The gentleman from Minnesota's time has expired, and the chair will recognize Mr. McHenry from Texas.
Thank you, Mr. Chairman. Ms. Fox, a basic question for you. If payday loans were prohibited nationwide, let's say we did that legislatively, what do you think would replace it?
If payday loans were prohibited nationwide, consumers would save billions of dollars.
But what would
in
replace it?
lending. Consumers would use traditional small loan companies. That's what happened in North Carolina when payday lending was
I'm from
expelled
North
the
Carolina,
state.
and that's not truly the case. They
Thank you.
travel to South Carolina. They use other mechanisms. I mean, the people need short-term lending, and what you're saying is, in essence, people will just bounce a check.
Very few consumers deliberately write a check to bounce whenever they don't have sufficient money. That tends to be something that catches you by surprise when your bank lets your debit card
Sure,
transaction go through. But there are
Reclaiming my time, let's reference the Federal Reserve report that is submitted for the record. Federal Reserve report expresses that in states like Georgia and North Carolina, there are, the example they use in the report, you have more complaints to the Federal Trade Commission about lenders and debt collectors. You have more bounced checks in that state. You have higher bankruptcy rates in that state, and they don't allow for payday lending. So explain to me how this is a rational argument you're making, because human nature, there is obviously a need for this type of short-term lending. Do you disagree that there's a need for it?
There is a need for small dollar lending. The short term is part of the problem. The Federal Reserve report you're referring to is one staff member's draft report. It's not an official report from the New York Federal Reserve Bank. They looked at aggregate data. They did not look at individual consumer experiences. For example, during that period of time, there were more complaints from D.C. consumers about debt collection to the Federal Trade Commission than there were from Georgia. So the standards that he used to try to describe what was going on
So you just
are too
I'm trying to talk about
aggregate. They aren't a good description. If you look
Okay.
at research done looking at actual consumers who use payday lending, every one of them shows it's harmful.
Okay, great. So you're saying that there's just simply, there is a demand for it, but you don't think it's good for consumers to have this option?
We think there's a demand for small dollar loans that are served by credit unions, by credit card cash advances, by traditional small loan companies that make installment loans to consumers. This market can be served and is being served.
What if you don't have a credit card?
A third of the people live in a state where payday lending's not permitted.
Sure,
and
you know what they
small dollar
do?
loans.
They travel across state lines in North Carolina.
In
I've
New
seen the
England, they
effects in
don't.
North Carolina. Pardon me?
In New England,
Well, I'm
that
not
would
from
be
New
unlikely.
England. I'm giving you the North Carolina experience.
Yeah.
And you've mentioned that basically in North Carolina, that we haven't suffered based on a prohibition of payday loans.
That's what the Banking Commissioner's survey of North Carolina consumers found, that they didn't miss it. They were glad to see it go.
Well, that's okay. Well, certainly, in terms of who they deal with and the regulated, you're saying that one person's opinion is invalid from the Federal Reserve, which I think the American people know is pretty valid, and another person's is very valid based on your political perspective.
Well, the North Carolina Banking
Mr. Flores,
Commissioner had an academic...
let me actually go on to someone else, Ms. Fox. I don't have much time, and we obviously know your perspective on this, that you understand the demand, but you don't think it's possible or necessary to fill that demand with a regulated means. Mr. Flores, you do a lot of work on this, and the question is, do you have an opinion on whether consumers are better off or not better off to have a regulated payday alternative?
Sir, they're much better off. It's a $40 billion demand annually
Why are they better off?
for this type of credit. That $40 billion would have to be met with other vehicles. And right now, that other vehicle is basically an overdraft or a credit card advance. Credit card advance is very expensive. You have an advance fee of 3 to 5%, and in these cases, you're going to have APRs well north of 20%. And most people will make minimum payments and they'll never get out from under it, versus a payday, which they fully plan to pay off in that 1 week or 2 week period.
Well, thank you, Mr. Flores. And what I would say is you're missing a third option, which is the illegal option. And, Mr. Chairman, if you'll give me 15 additional seconds, there's a third option, which is the illegal option, which instead of charging a high interest rate, the experience I've had with individuals I knew and worked with in my family's business, that they could get lending. And it was dollar for dollar lending. If you wanted $20, you paid $20.
The gentleman's time has
If you
expired.
didn't pay, yeah, your leg's broken. That's the illegal option, and that's unfortunately what Ms. Fox is really trying to put
The
people
gentleman's
into.
time has expired. The chair will recognize the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Let me begin by sort of going over a little bit here. First, let me deal with the state's preemption issue. It certainly is the intent of this legislation not to interfere with those states who already have laws on the books of whatever nature they may be. And I think when we get to my colleague from New York, Ms. McCarty, she's going to go into a little more detail with this, because there are varying understandings of that. But certainly this legislation is a targeted piece of legislation that targets 23 states that do not have any regulatory reform on payday lenders. It is also an effort by this body to get a bill passed that will prevent some major protections for consumers and our constituents who want this service. Whether we may want it or may use it or not, there is a niche and a market that is there that consumers want and need. Let me just very briefly, Ms. Fox, are you aware that this legislation that we have caps interest rates and fees for short-time loans at a combined 15%, and at the same time gives borrowers liberal, very liberal repayment loans that are structured in a way that will not take them into this cycle of unending debt.
I'm glad you've asked about that, because there are some states that have tried using an extended repayment plan, and it hasn't worked to prevent payday loans from being a debt trap. In those states, they have the same average number of loans per customers as the rest of the states that authorize payday lending. And that's because the payday lender, whose profit is based on getting consumers to renew loans one after another, has no incentive to encourage people to use the repayment plan. You have to ask for it. So in the states that have tried it, only 2 to 3% of the eligible loans end up going into the repayment plan. We have the same problem with the renewal ban. It prohibits renewals. Well, all but 5 of the states that permit payday lending prohibit renewals in one way or the other, but consumers just come in on payday, pay off the loan, and now they don't have enough money to make it for the rest of the pay cycle, so they write a new check, they take out a new loan. It's not counted as a renewal, it's a back-to-back loan, and that's how people get trapped in the debt trap.
All right. But what I'm saying is, you support the measure that we have in the bill, or do you not support in this legislation our language that will regulate and will impose balanced criterion on these loans, which specifically address the cycle of debt and excessive interest rates that result from continually refinancing or rolling over these loans? That is the crucible of the issue that this bill addresses and stops, which is the most egregious point in payday lending.
We think this bill authorizes egregious lending. It authorizes writing unfunded checks to get loans. It authorizes a payback term of as little as 2 days. It authorizes back-to-back loans, one right after the other. and it does not serve as your intended consumer protection.
Right. Well, do you believe, Ms. Fox, that these 23 states that have nothing, that this bill will offer some help and a regulated form is needed?
It doesn't offer much of a reduction in the rates. For example, in California, payday loans
But my
cost
question is
$456.
that, and I agree, we can't deal, we here have to fashion measures to try to respond to constituents' needs and measures that we can develop the coalitions and alliances of thought that we can get through this body.
Well,
And so the point I'm saying is, would not these 23 states be better off with this effort of bringing some relief and some reform in the regulatory reform? Just yes or no, that's all I wanted to know.
No, they would not be better
All
off
right.
because
Ms.
of all the
Guzman, let me
loopholes
ask you
in the
this,
bill.
because I only have one question. I understand, I believe you've used payday lending, is that correct? So I think that your comments will be very important. May I just ask?
The gentleman's time's expired.
All right.
Is
Just
Mr. Marchand from Texas.
Thank you. First of all, my position on this, after serving 18 years in the state legislature and dealing with this issue every single session for 18 years, is that this is an issue that very much deserves to be debated and decided in the state houses. I do not believe this is a federal issue. I'm with Mr. Watts on this issue. I do not believe that you can write legislation on this kind of a subject at the federal level and try to force it down on states who have clearly had the opportunity. Probably every year they meet, these 23 states have had the opportunity to take this subject up. So I'm not for the legislation simply because of that. As far as trying to set federal lending limits and actually have the federal government set rates on a private transaction, a legal private transaction, that also is something that I'm not interested in. Perhaps there's some venue because there's federal insurance on the banks. There may be some case to be made for preemptive rights of the federal government to go down and talk and pass ordinances and laws for banks. In Texas, we were the last state in the union to have branch banking because we felt like it was a states' rights issue. We were the last state to pass home equity loans because we felt like it was a states' rights issue. So I'm very much a states' rights issue guy on this here. I do not believe that the federal government can effectively regulate this industry. I represent a district that throughout my career, I always felt like the payday lending industry was an industry that I would see in districts where there were a lot of working class, a lot of people that live from paycheck to paycheck. But my district's a suburban district near Dallas. And if you walk into one of the payday lenders in my district, you're going to find housewives, you're going to find school teachers, you're going to find factory workers, you're going to find people who work for the city, and you're going to find people that I don't think that we have given enough credit to. These are people that can add and subtract and multiply. They know that bouncing the check at the bank is not a good thing. They know that it is costlier to go to the bank and bounce a check than it is to go to the payday lender. They know that it could hurt their credit rating if they make a credit card payment late. They know that the credit card late payment is probably going to be more expensive than the payday lending rate. So I like the testimony of the gentleman from Louisiana. We think that our system in Texas is working very well. I would like to give the other 23 states that have decided to not do anything about it or still haven't decided what kind of laws they want to make, to continue to have those rights and to continue with that. For that reason, I'm going to be against the bill, and thank you, Mr. Chairman.
Gentleman yields back. Chair will recognize the gentlelady from New York, Ms. McCarthy.
Thank you, Mr. Chairman. I appreciate it, and I appreciate this hearing. First, let me say and join my colleagues from North Carolina and Georgia that, in the state of New York, we do not have payday lending, but we do. Yeah, it's just a different form of what you're talking about. What is defined and regulated by the state as a payday loan, they have operations that offer similar products but don't meet all the principles of a payday loan, so they're unregulated, and that is a grave concern. And I think that's what we're trying to get at. Now, I know CFSA has best practices for the payday advanced industry. A lot of that has been put into this bill. The only difference will be that within this bill there'll be teeth, or where we can actually do regulate that if that's what is going to come down on the road. So to say that some of the states don't have any form of payday, I find not true. But the other thing is too, in my area where we have quote payday lenders, we don't have any banks. So where are those people that live in those particular areas? There is no banking. The other thing is, in almost all the banks I know, you have to have an account to go in and cash a check. So again, we're finding problems with that. If it's a paycheck from a whatever the job is, and they have an account there, maybe the bank will cash that check. But otherwise, you can't cash a check there. So I guess my feeling is that I want to go to Mrs. Fox. It's my understanding that the Consumer Financial Services Association of America has a list of best practices that their members must follow, and that the legislation reforming payday loans, H.R. 1214, puts a cap on interest rates that is lower than the fees allowed, again, in 23 states that allow payday lending. Could you explain how a payday loan could be worse than the consequences of not being able to obtain a short-term loan from a financial institute, forcing an individual to bounce a check, as we've heard from many of my colleagues? And I think that's something that we have to take into consideration. We want to basically, there's no one here on the Republican or Democrat that wants to condone anyone that is ripping off any of our constituents. Nobody does. But the fact of life is that we need to have people, when they want to cash their check or have a short-term loan, they need to have a place to go. To me, it's almost like an ATM machine. Here are your prices. If you want to borrow or take money out with your credit card, you're going to pay an upfront fee. And if we can do that with some sort of regulation, I think that it's better than what it is today.
In New York, your 25% criminal usury cap prohibits payday lending, and although you have check cashing outlets where people pay a fee to turn a paper check into cash, that's not a credit transaction. I know you do have refund anticipation loans that are expensive in New York because those are offered by banks, and New York can't regulate those interest rates. But there are other options. Everybody that gets a payday loan is a bank customer. You have to have a checking account open in order to write a check. You can apply to your bank for real overdraft protection at a lower cost. A lot of credit unions offer low-cost small loans to their members. In Pennsylvania, the treasurer of the state puts deposits into credit unions to encourage them to make very low-cost loans available in Pennsylvania.
I agree with you on that, but I'm saying to you, I know in certain districts, part of my district, they don't have a credit union. They don't have a bank. Where are they supposed to go? They also probably don't have a car. So where do they go?
Most people, when they have $100 or $200 shortfall, turn to their family and friends. They deal with whatever the credit emergency is. They call the utility company and ask for extended payments. They ask the landlord for
Mrs.
a bit
Fox,
more time.
I'm not trying to give you,
400%
Mrs. Fox, I'm not trying to give you a hard time, but We're talking about people that are probably on the very lower end of income. And most likely their family members are not going to have money. But with that, I saw that Mr. Flores, you had wanted to say something?
Yes, I'd like to respond to that. When you go to the bank to apply for a traditional overdraft line of credit, which would be akin to a credit card, many banks that I've dealt with who have actually formalized these overdraft programs have limited or eliminated offering the traditional overdraft line of credit because there is very little revenue associated with that product. The revenue is all in this overdraft protection program. So I think it's very difficult to say that people have the option to go in and get this because banks have looked at the profitability of all these products, and given the interest margin squeeze they're all facing right now, they're looking for the most profitable products they can offer.
Thank you. With that, I yield back my time.
Thank you. We're going to go to, I just want to alert the members that when we begin these hearings, there are 10 minutes per side by unanimous consent for opening statements. And if people want time, they will be allotted that time on the basis of their seniority in the committee so that everybody has ample time to be able. The gentleman on my right takes care of that side, and sometimes people don't get to speak. I assure you, when I was here 17 years ago and I was way down there on the fourth row, I would have hoped these kinds of rules would have been in place. Mr. Cleaver, you're recognized for 5 minutes.
Mr. Chairman, this is one of those times I know people assume that we come here with positions already in concrete, which is not true for me, certainly not today. Most of the assumptions I came in here with have dramatically changed, although I am not a fan of payday lending, not at all. But I am concerned about, and I'm not sure anyone has addressed, a way in which we can provide necessary services to the unbanked. And it is also, the unbanked represents an untapped market. And I'm a federalist, so I'm not interested in supplanting federal legislation, of supplanting state legislation with federal legislation. And so I'm really struggling with exactly where I am. The only thing I know for sure is that I don't like payday lending because I think some of the practices, frankly, when you have fees of 300%, as happens in some places, that can't possibly be good. But on the other hand, what do we do to provide service to the unbanked? Can anybody? Yes, sir. Mr. Flowers.
Mr. Cleaver, I have worked with clients in the past who've tried to address the unbanked situation. And the key to the unbanked is the first product they need is the checking account. And some of the strategies that have been employed is what's called a checklist checking account, where direct deposit is made to eliminate any potential fraud on the deposit side or returned items on the deposit side. And no checks are permitted, only the debit card for ATM withdrawals and point-of-sale transactions, which would eliminate any potential for overdrawing this type of account. Once somebody establishes that and over a period of time has a track record, then they go that next step in developing the appropriate credit.
So the problem is, thank you, I hate to cut you off except my time is moving. And the problem with that is when you go into the urban core, there is no gradualization because there is no bank. You know, you can ride around in the urban core for miles and miles and not come across a bank or a grocery store for that matter. But so, Ms. Guzman.
Congressman Clemmer, let me say that going back to my statement of an evil but a necessary evil, and when we deal with evil, we try to minimize the impact. And I think this legislation and legislation like it that permits payday lending establishments, however, regulates or caps the fees to protect the consumer are the only answer. Unfortunately, addressing Mrs. Fox, some of my constituents, many of them, of my neighbors, do not have family members they can turn to for a payday lender type situation. We have a transient population right now with the economy where people move from community to community, state to state to find jobs. Many of them are first-generation Americans, native-born Americans. They do not have a family support base or safety net here. So, as I stated, payday lenders, there is a market for them, there is a need for them, and I would just be very grateful if we
Yeah, but
protected the consumer
where
whenever
I'm trying to
possible.
go, thank you, where I'm trying to go is, and maybe I'm inarticulate,
What is the answer?
what happens to the people who live in areas where there are no banks?
There are programs,
Ms. Fox?
there are programs that have been launched in a lot of large cities. It's called Bank On, where the mayors and local civic leaders are working with banks to encourage them to provide the basic entry-level banking services that the communities that you're describing need. My organization, Consumer Federation of America, is working on America Saves campaigns across the country to try to help low and moderate income consumers become savers. We have new data out from the Federal Reserve that compares people who use payday loans with people who don't, and the folks who don't use them are twice as likely to be savers than the folks who end up at a payday loan outlet. So there are creative programs being worked on to bank the unbanked. The problem is once you get these consumers banked, now they are the prime market for a payday lender, since having a checking account is a prerequisite, but they don't have enough money to be able to pay the loan back all at one time on their next payday.
Yes. Thank you very much.
Thank you,
Time
Mr.
has
Chairman.
expired. 10 seconds to go out of order, unanimous consent. I'd like to ask Mr. McCullen a question before we go any further. Hearing no objection, so ordered. I have your statement here, last paragraph. I respectfully request that you defeat this bill in its current form or alter it to mirror the Louisiana law, which allows $20, which allows 20 cents and a dollar plus per dollar, sorry, and a documentation fee. So you're against the bill in its current form. Is that correct?
Yes, sir.
Thank you. Ms. Gentlelady, Ms. Spears, is recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Guzman, I have a question for you. If you could get a payday loan for 36% instead of 300%, would you like that? So would you support a bill that had a interest cap of 36% instead of 300%?
I would support anything that would.
Would you put your microphone on, please?
I apologize. I would support anything that would minimize the negative impact to consumers or my neighbors.
Yes, Mr. Flores? Would you
to-
support that?
Well, it sounds good, but the issue is when you do a 36% annual percentage rate, that means it boils down to a $1.38 fee for a $100 advance. And no one can offer, there's not a business model that will allow anyone to even cover their cost and offer that product. So while, yes, it sounds good, and it is 36% on a traditional installment loan makes sense, for this type of fee product, it does not make sense because you would put the industry out of business. And you'd
Well,
have $40 billion
maybe
in
some of us think that the industry has overstayed its welcome.
Well, yes, ma'am, but-
That's Mr. Flores. That's all I have to ask for you. It appears that the payday lending industry is losing some of its momentum. In fact, there hasn't been an initiative that they brought before a state since 2005 that has actually passed, because the people in our communities recognize that 300% interest rate is not a good interest rate.
Right.
And in D.C., as I understand it, it has been prohibited. Payday loans are now prohibited, as they are in New York and other places. And I've got to believe that in huge communities like that, where there are a high percentage of low-income people, they're finding other ways to get credit when they need it. The question I have for you, Ms. Fox, is the following. What are the loopholes in this bill?
The bill defines a covered payday loan as only closed-end, so it leaves out all the payday lenders who've turned their product into an open-end product. For example, in Virginia, Advanced America makes open-end loans. Same cost structure, same term for the loan. It's just they called it open-end. It would not be subject to this bill. Any loan that was for longer than the 90-day definition would not be covered by this bill, and payday lenders have already changed the term of their loans in order to get around that kind of definition as well. We're also concerned that the Credit Services Organization model, which is used widely in Texas, Texas has never passed a payday loan industry bill to allow payday lending. Their Texas Finance Commission rules would permit it under their regular small loan law, but most lenders in Texas call themselves credit services organizations and charge a high fee for arranging a loan with some third-party lender. It's not clear to me that they would be subject. So we have a bill that would leave out almost all of payday lending in Illinois, probably all of it in Texas, a big chunk of it in Virginia, and it would be very easy for lenders in 10 of the 23 states that permit higher than the 390% cap in this bill to just change their product into an installment product because there's no rate cap on installment lending. So it would be very easy to get around the definitions in this bill and keep right on charging 500, 600% without violating this bill.
So what would improve the bill?
It would improve the bill to prohibit holding the personal check as security for the loan, to make these loans on the basis of a contract.
Let me ask you a question on that.
Yeah.
It seems to me almost illegal because you're not supposed to provide a check if you don't have sufficient funds.
You'd think so, wouldn't you?
So they're basically asking the person to conduct themselves in an illegal manner by offering up that check that they don't have sufficient funds to use.
That's true, and in some states, the payday loan law has to exempt these customers from being subject to the criminal bad check law because otherwise they would be. But the lender knows you don't have money in the bank when they take the check, but they hold it, and that adds costs for consumers. In Virginia, people paid in 2007 about $5 million to their own banks in bounce check fees because their payday loan checks were returned.
Okay, so that would improve the bill. What else would improve the bill?
A longer loan repayment term. If you gave people 5 months to repay your payday loan as structured here at $15 per 100, that gets it down to 36% APR. We know from the chart I included in my testimony that the typical family making $35,000 a year cannot pay all of this back out of one
The
payment.
time of the gentlelady has
you.
expired. Congressman Maxine Waters from Cal.
Thank you very much. I'm going to yield to the gentlelady from California. I just came in. Her line of questioning is exactly what I looked forward to doing. So, Ms. Beard, would you continue your line of questioning, please?
Thank you. So we had so far established that if you would not require them to hold a blank check, that would be an improvement to the bill. If you could provide within this bill a longer repayment period, that would improve the bill. What else would you?
And a reasonable small loan rate cap. Competition does not drive down the cost of payday lending. You may have a payday lender on every corner, but they are all typically charging the legal rate. It takes a rate cap to bring down the cost of loans to consumers who have little power in the market. And the traditional small loan rate cap of 36% is a reform that consumers say they want to have. If you do polling that was released just this last week, 70% of Americans want a rate cap of 36% or less to protect consumers from rate gouging. And that's the rate cap that was upheld in voting at the polls in both Ohio and Arizona last fall. Consumers don't think that creditors should be allowed to charge 400% interest.
You know, Ms. Fox, just to point out to you, when I introduced the bill that would create a usury rate of 36%, I had people in my district calling me saying that's too high. Well, so they would find this particular conversation particularly interesting, I think. I yield back.
Yeah.
Lady yields
Am I-
back. Mr. Paulson?
The gentlelady is yielding back and her time to me. Let me just say, Mr. Chairman, that the payday lending has always been a real concern of mine. And you're right, I happen to have a portion of my district where we have a lot of lenders, and the argument is made that, you know, people depend on this kind of lending, but I just think that, you know, 300–400% is way too high. Let me tell you what I've began to think about payday lending. We've been dealing with subprime loans, and we refer to many of the deals as exotic lending, where we had Alt-A loans that they didn't do verification on employment. We had adjustable rate loans that were just outrageous in the amount of money that cost the taxpayer when they reset with these high margins, and on and on and on. And we're calling for regulation, and we want tighter regulation. The same thing is going on here. We have products that are injurious to our consumers, and we need to crack down on this. Just as we're looking at the subprime loans and the mess that was created, we have a problem here with people making very little money who will never be able to get out from under this kind of debt unless we do something to crack down. Now, this has been going on for a long time, and so, Mr. Chairman, just let me say that no matter what the intent is, the fact of the matter is we've got to resist any attempt to make it look as if we are cracking down, when in fact we're opening the door for more abuse. And I will yield back the balance of my time.
Lady yields back her time. Mr. Paulson, you're recognized for 5 minutes.
Thank you, Mr. Chair. I know a lot of the questions I had already been asked, but I wanted to ask Mr. McCullen first, perhaps. You know, how would the legislation, H.R. 14, really impact your business? If you can just describe how the legislation would impact what you do.
The legislation that's being discussed here today, if it had been in place in Louisiana last year, I would have ended in the negative. That's why I'm here not to support this bill. I ask in my testimony that you implement the Louisiana bill, because I am listening to all these different things being said here. We don't have these problems in Louisiana because it's against the law. We had 24 complaints last year, and we had over 4 million transactions. We have a very tight, succinct bill that we're able to operate under and protects the consumers. So that is why I was against this bill.
And then I'm just curious, Mr. McCullen, then, I mean, who would really benefit from this law if that's the case? I mean, is there another product that's similar to yours that you offer? And I had mentioned this in my opening statement, but, you know, on a widespread basis, is there any other product that's offered that really substantially is available at lower costs for people?
Not to my knowledge, no.
Yeah. And coming from Minnesota, Mr. Chair, I mean, it's a case where I've talked to people in this industry, too, that, you know, their average interest rate that they'll charge is only 9.5%. And so a very reasonable level. And, you know, Ms. Fox had mentioned earlier her concern about triple-digit APRs, and you know, I'm just curious, what do you think of a 99% APR? Ms.
It's
Fox?
still high. It sure beats 520%, which is what they can charge in Louisiana for single payment loan. We think that the traditional small loan rate cap in states has been around 36%. It provides for loans to consumers who don't have a perfect credit rating under an affordable repayment schedule, and we think that it would be more beneficial than what's being proposed here.
Well, I think it's also important to point out that it would be very beneficial for consumers down the road to not necessarily rely on the description of an APR. I don't think consumers understand what APR means necessarily, and just regulating not having that triple-digit APR, it's going to be much more easier for consumers if they understand what real fees are. We've seen that in the credit card industry. Mr. McMullen, do you have a comment on that?
I appreciate that comment, because I wanted to bring that to the table. Most Americans do not understand APR. I have lots of friends of mine that are personal friends of mine. They do not understand what we do and how we do it. When I explain it to them, they understand, but this is a flat fee. And I also want to make a comment about APR. the American Banking Association testimony that was before the subcommittee on March 19th said with regard to applying APR to overdraft fees, another short-term credit product, quote, anytime an annual percentage rate is calculated for a term of less than a year, the inclusion of a fixed fee, even a modest one, will distort and overstate the APR. The shorter the repayment period, the greater the APR will appear in instances where there is a fixed fee. This means that the sooner the consumer repays, the greater the calculated APR. A difficult concept to explain to consumers, as it appears that are paying earlier actually increase the cost of credit.
Well, and Mr. Chair, it just points out I think there are some states that have done some good things and have some good models, and Minnesota and Louisiana might be another case too, and I hope we consider that as the legislation moves forward. Thank you. Yield back.
Thank you.
Thank you. Mr. Sherman, you're recognized for 5 minutes.
Thank you. I'm a bit confused about using APR as a way to determine the fairness of the fee. Ms. Fox, I was once at my bank an hour before it opened. Usually I'd go inside to get a couple $100 out of my account, but I wanted the money an hour sooner than I could get it because, like, they were closed. And so I went to the machine. I paid. My bank was good. They only charged me a $1 fee to get my $200 an hour early. $1 to get my $200 an hour early. Now that's 186,000% APR. Am I an idiot for paying 186,000% APR to pay that $1 fee just for an hour?
Was the $1 fee to borrow the money or just a fee for accessing it through the ATM rather than in person?
It's a time value of money. I was going to get the same money sooner, whether it constituted a loan for the hour, which was then repaid to the bank without further cost or otherwise. I mean, I got my money an hour early, time value of money, 1 hour, $200, 186,000% APR.
I would never say that a member of Congress was an idiot. So
everyone else does.
I would never.
Okay.
But I would say,
should that transaction be banned because it's 186,000% APR?
Well, that's not the product we're talking about today.
I'm asking you a question. You don't get to confine your responses just to what we're talking about today.
Has been the law of America for 4 decades. It requires that credit be quoted with a comparable price so you can compare a 1-month pawn transaction, a 2-week payday loan, a 6-month installment loan, a cash advance on a credit card.
When you're doing things for a short period of time, I mean, if one payday lender charges $30 to use the money for 2 weeks, and another one charges $40 to use the money for 3 weeks, you don't necessarily say that the higher fee is the better deal. Time value of money is something I understand. I'm a CPA. Yeah. I also understand it just doesn't make any sense to evaluate a fee-like transaction.
Well, we disagree.
Okay. The other point I'll make is I deal with my constituents. They know I'm a CPA. They ask me all kinds. The only financial transaction they do understand is the payday loan.
Well,
none of them understand just about anything else. But you say, okay, you use your credit card and you pay most of it off, and then you use it some more. How much is that going to cost you? They got no idea. The only you pay your you use your overdraft protection. How much is that going to cost? Nobody knows.
Well, if this subcommittee would enact Representative Maloney's overdraft bill, consumers would get truth in lending cost disclosures for those loans as well, and we think that would have
what I'm questioning is whether
truth
in lending makes any sense at all for loans of less than a month or 2 months. What you think of as great information to my constituents is gobbledygook or misleading.
Well, requiring loans to be repaid in less than several months also doesn't make very good sense for consumers in the income bracket that use payday loans.
Some people only want to buy. I see my home girl from the San Gabriel Valley, where I grew up, Aztecs. And I mean, were there occasions where you needed the money for only a month, or did you always have a need for the money for 3 months or 4 months or longer?
No, on that particular occasion that I discussed earlier, I did only need it actually for 30 days. What I did was I paid it back because I'm not allowed to roll over, and literally borrowed it back at that moment, again, paying another fee because I couldn't pay it back for 30 days. But, you know, I was able to pay it back.
So, but you only held the money for a grand total of 30 days?
Yes.
Okay, so if we forced you to take the money for 60 days, but we charged you just a little bit more, would that help you?
Well, it would at least give me the option of not having to pay it back in 2 weeks. I'm just saying, in my, Congressman, in my experience, everyone's situation is different. I do have very well-intended neighbors who would need the loan.
The gentleman's time's
I'm sorry.
expired.
Okay, I just asked the witness not to tell anybody in the San Fernando Valley that I actually grew up in the San Gabriel
lips are
Valley, and I'll
sealed.
yield back.
Yes, we ban rollovers in this particular bill, and we give you 90 days to pay the money back, so you wouldn't have had to pay the fee again. Mr. Childers is recognized for 5 minutes.
Thank you, Mr. Chairman, and I have been following between votes and earlier part of the panel. I want to thank you all for being here from my office. And I think this has really been touched on today, but I really wanted to address the issue, Mr. Chairman, of regulating by the states. And I just want to go ahead and say this. I am from Mississippi. Mississippi is no different from all the other states. We have varying degrees of people in need of various amounts of loans and sizes. I come from a state, quite frankly, that does a good job of regulating. They do a good job of regulating banks. They do a good job of regulating consumer loans. And they do a good job of regulating payday loans, if that's what it is to be called. Now, at my age, I have survived many eras, let me just say that. And there are times that I needed a little bit of money, and there were times that I needed a lot of money. And I'm not so sure that this is really the avenue for us to take on this. And I will say this, I'll use my own state as an example there. It is my belief that customer John Doe will go to the place where he can borrow money, or Jane Doe will go to the place they can borrow money for the least amount. I believe that. I've done that in my life. There are times that my own hometown bank probably charged me more than my neighbor. But there were a lot of factors. Maybe my credit wasn't as good at that time. Maybe he thought I already owed too much money. I wanted to make that just as a statement, really, and to the panel, and I understand each of your interest, and I appreciate that. I had read what you delivered to us, and I have listened to you while in my office in between these votes today. But my state does a good job, and I really have nothing but compliments for my own state. And in my state, the payday loan companies seem to be the target, if you will, of maybe this discussion today. The people there, and don't get me wrong, I'm certain that there have been instances where people have been aggrieved. It is like any industry. There are always some who have been wrong or believed to have been wronged. By the same token, I saw this industry in my state, and regardless of what I personally think about that industry, I will say this: they stepped up and worked with the state of Mississippi to regulate themselves to a degree, or to accept regulation so they could stay in business. I'm anxious, I welcome any comment from the panel back, but I just wanted to speak, I guess, on behalf of state regulation.
Congressman, I was just looking at my study, and for the state of Mississippi, since you do allow payday lending.
Mr. Flores, could you put your microphone on?
I'm sorry. The state of Mississippi, the average consumer who has a checking account pays $163 in overdraft and NSF charges, compared to the national average of over $300. So again, according to my opening statement, is there a direct correlation? I don't think there's enough data yet, but there's certainly an indication that we ought to look at it in more detail. And so the consumers in your state are paying less in overdraft charges than consumers in many other states.
I would agree there probably isn't enough data to say that is it, but it is if it's a fact. It just is what it is. Thank you, Mr. Chairman.
You're welcome. A couple of quick questions to Ms. Fox. You said, is it your testimony that competition will not drive down the price of payday loans?
It has not.
No,
it has not. No.
Okay. So supply and demand works everywhere else except the payday industry.
That's right.
Okay.
They feed
Good.
off
I just wanted to make sure that was your testimony.
Yep.
I can tell where you're at. And then your testimony is that the bill would force payday lenders to change their product.
It would give them an incentive to change
So they would.
their product.
So it would. So while it has nothing to do with the driving down the price, it will change their behavior in terms of changing their product to installment loans.
From past experience.
From
that's
past
likely to
experience.
happen.
So it does have on one, but not on the other. Everyone's had opportunity. I would ask unanimous consent that a letter supporting the goals of this legislation from the National Association of Federal Credit Unions be entered into the record. Hearing no objection, so ordered. I want to thank the witnesses and the members for their participation in this hearing. The chair notes that some members may have additional questions for the witnesses, which they may wish to submit in writing. Therefore, without objection, the hearing record will remain open for 30 days for members to submit written questions to the witnesses and to place their responses in the record. This subcommittee hearing is now adjourned.